In brief, our investment process is quality driven. We focus on companies that have low costs, strong growth profiles, very good balance sheets, and management teams that can execute those growth profiles. A final thing I would add is we look for companies with strong or improving ESG profiles, and we spend a lot of time and money on the road making sure that we understand the risks involved in the companies in which we invest. This process has been going for 20 years, as long as Jo Warner has been with the firm, and nothing is going to change with her departure. Our quality-driven investment process has delivered enduring success over the 20 years that we've been doing this. Over time, we've generated an 8.6% absolute return and 1.7% outperformance of our benchmark for our flagship Aussie-denominated fund. The quality-driven aspect, however, can work against us at various points in time, such as the last 12 months, during which we've seen a rebound in the resources sector from very depressed levels, which tends to favour more financially levered or operationally, i.e. higher cost companies. This doesn't favour the quality-driven investment approach, and we've therefore lagged the benchmark over the last 12 months. But over longer time periods, what drives our performance tends to be our investment in what we call the acorns and the saplings of the sector. These are the smaller growth-oriented companies who deliver value over time, almost regardless of what the cycle does. The long-term driver of commodity prices is ultimately growing demand against a finite supply of commodities. It's different for different commodities. What we see at the moment is quite a good backdrop across the sector, given large decreases in capex by the miners from the peak of over $55 billion for the big four miners in 2011 to around $13 billion this year. That's all in growth capex, which means that as we go forward, some commodities may find it hard to see the supply match the demand, which could lead to spikes. The big driver of commodity demand, China, is slowing down and shifting its consumption pattern away from industrialization and urbanization towards more consumption-driven commodities like copper, nickel, zinc, and others. As far as being a hedge against inflation, we think that commodities very much are a hedge against inflation based on studies that we've seen that show a strong correlation between the two. And in particular, resources equities tend to be a good asset class in periods of high inflation of, say, 3% and higher. There are a couple of macro issues that we think a lot about. The first one would be the broader environment for interest rates and inflation. Inflationary expectations are very low at the moment, and so are interest rates. And that's pushing investors into bond proxies and growth stocks. The bond proxies of our space would be things like the integrated oil companies, which we are frankly underweight at the moment for stock-specific reasons. I think that there is a danger that some generalist fund managers who are positioned in this way may suffer as inflation expectations and interest rates start to rise, pushing investors into more cyclically oriented stocks. And we saw that recently in the last 12 months when the US 10-year moved from about 1.4% to 2.5% and the miners went ballistic. Then as the US 10-year dropped back down to 2% between March and June of this year, we saw the miners correct. This shows us that there is quite a strong correlation between inflationary expectations as expressed in bond yields and the mining sector's performance. Another area that we think a lot about is the ongoing electrification of the car fleet and the decarbonization of economies, which has a negative impact on certain areas like coal, which we happen to be underweight of for quite stock-specific reasons, but also will have positive benefits for things like copper, nickel, and lithium. We happen not to be invested in lithium at the moment because we worry about supply coming in for a commodity which is ultimately very abundant and one which has only been used for a couple of decades industrially. Looking at copper, we're much more optimistic. Even in a modest case for electric vehicle adoption, we could see copper demand more than double, whilst we're looking at a commodity which has been industrially used for over 120 years and where supply is becoming increasingly scarce. And unsurprisingly, you'll find that we have quite a lot of exposure to the copper space. There are three reasons that investors should consider buying the mining sector right now, in our opinion. The first would be the fundamental backdrop, where we see the cycle turning as fundamentals change. The second would be valuation, where we see the sector looking reasonably attractive if you believe that commodity prices hold up or indeed rise. And the third would be positioning, where we see investors as very underweight the sector, particularly in energy, but also in the materials side.